GM, everybody, welcome to another Treasury Tuesday. Today is March 14th, 2023. It has been a crazy week over the weekend, especially, but I guess that's nothing new in crypto, and I guess that's our lives we have to live with, but it's definitely fascinating. Lot to cover today. You'll see the agenda posted in the chat above, and then also in the updates channel. I encourage you guys all to follow along with that, especially this week, just because of the litany of, I guess, links that you can kind of use to follow along and kind of get a little bit deeper with what we'll be discussing. But let's go ahead and dive onto it. So as always, we'll start out with the recent events and news section. I think a lot of times we kind of go straight into the proposals, but with all the news, there being so much potential discussion, we can kind of get into that first. And I will say that with regards to like the Silicon Valley Bank, we'll definitely have a lot more discussion around that as it relates to USDC depeg risk. But I think everybody knew over the weekend that we saw, well, maybe not over the weekend per se, but we saw the collapse of Silvergate Bank as well as the Silicon Valley Bank, and we also saw what some people are tagging as a collapse of Signature Bank, but it's more of a seizure. So we can get into that, what that means as well. We saw USDC depeg, I think it got actually down to like 88 cents over the weekend before rebounding basically back to $1, which we can see now. So definitely a lot of fear and unknown in the markets, but glad to see that it's calmed down just a little bit on that front. We also saw a KuCoin lawsuit by the New York Attorney General, basically that they were offering unregistered securities, and one of which was listed was ETH, which is kind of an interesting and definitely departure from what the CFTC has said, defining ETH as a commodity. So something to pay attention there. One thing I will say about that is just because somebody in that position says that does not create any kind of legal precedent. It does not actually create any major ramifications from what I'm aware of. It just focuses mainly on KuCoin's operation. If it were to go to court and a judge were to rule it a security or some other agency or Congress, or I guess I'm talking U.S.-centrically here, that would have actual ramifications. But as of now, this really is a nothing burger from my perspective. Something else to be aware of is the Bitcoin associated with the Silk Road. You can see the link in there on like a little bit discussion if you're not familiar with that. That is a little bit on the move. You can see the tracked wallet there. I believe that's been sent to Coinbase. I am not paying attention to if they've been liquidating that and how they may liquidate that. They do. But that is something to be aware of because it's a lot of Bitcoin. So that's been on the move for years to come, and it's finally found a home on Coinbase, and we'll see what happens from there. But definitely track that closely. Some other things from the news perspective is really around Biden's tax bill. Some interesting things came out of that, and again, like this is nothing until it's approved, which I would suspect it wouldn't be just because of how divided Congress is, and just because some of the things in here are pretty amazing, or maybe not amazing, but pretty intense from a tax departure standpoint. So one thing that came out was he would like to tax about have a 30% tax on Bitcoin mining operations. I haven't looked into it too much other than that, but very interesting. I think it's a really bad precedent to set from how can the government choose what is a good use of electricity versus not, and how do they tax or not tax something like that. So definitely precedent that could be set there. In this bill, he also would like to double capital gains tax for certain brackets up to 40%, which is basically literally, like I said, a double from 20% as we see now. And then also he's trying to plug in the crypto wash trading rules. There's currently a loophole that doesn't really impact crypto. So basically, if you buy crypto and then sell it at a loss and then rebuy it again, right now you can actually tax harvest that loss. In compared to equities, that is not allowable. There's certain time frames that what's called a wash sale. So that currently could be closed up under this tax bill as well. So it's something to be aware of. And then finally, you will see that depending on however you want to say it, Euler, or I think the correct way is Euler, was hacked. Last I looked, it was about a $200 million hack. Definitely pretty sad based on like what I know about the team being pretty much gigabrains and them becoming very much closer to becoming core infrastructure and a core primitive for the space. So definitely sad to see that. We'll see how that shakes out. But again, I think that was most of the news since our last Treasury Tuesday. So a lot has happened. I know I skimmed through it really quickly, so maybe I'll pause there and see, does anybody have anything they'd like to kind of get into more? Or maybe they have a couple details they'd like to fill in the gaps, especially as it relates to things other than the banks, because we'll be getting into that a little bit more. Okay. Cool. As I said, we'll get into some of the bank collapse stuff in a little bit, and especially as it relates to USDC. But kind of turning our attention to the proposal section of this. So I'll run through these five proposals that are on the forum currently really fast. And then I have two other proposals just kind of give an update on. So I guess the first one is replenish discretionary investment limit KIP. This one is really just to allow us to, I guess, refill the coffers with regards to how much we can move discretionarily. And I think you've seen before we've done some buybacks with that, and then there's some other things that are listed in that KIP that would enable us to do that. Moving on to the next one, deployment of additional yield for yield generation. This is just really asking for approval to have some more of our idle ETH deployed into the same staking derivatives that we currently have. The expand funding and strategies of testing wallet. As you guys may know, we have been testing swapping stables, and we'd like to engage in more strategies beyond one-for-one swaps, and then also have a little bit of extra funding to see, what else we can take to the next level there. Then we have two external KIPs for, I guess, investment purposes. Treasury yield management for USDC via USV. This is the future team that came in previously. I encourage everybody to check that out. And then we also have a similar one that's similar in the sense that it's in the stablecoin deployment business with OUSD, which I know I see Peter here. So Peter, feel free if you wanted to speak up anytime. Hopefully we can kind of tackle either or both of those proposals from a SoFon perspective coming up. I would say, now that we have Nathan on board and we are going to start working through some of the backlog, hopefully we can get a little bit more traction on those two proposals. But again, Peter, feel free to hop in. Or if anybody else has any thought about those proposals, and feel free to say it as well.
Hey, Matt, I'll just speak up now since you've mentioned the proposal. Well, first of all, it was great to meet you and 50 and the rest of the team in Denver. It's always cool to see people face to face, so you know that they are real. Regarding OUSD, it did the token itself did depeg over the weekend since a portion of it is backed by USDC and DAI. It did not depeg as low and for as long as those two, which was nice. But the big silver lining to it was that it was actually a very profitable opportunity for OUSD holders. We ended up making almost, I think, $200,000 profit for those that were holding OUSD from, a portion from lending out the USDT collateral, which is one of the strategies, and also from the redeems for those that got spooked that OUSD was going to dip further. And so the APY on, I think, Saturday was almost 200% APY. And the day before and after was about 45%. And then yesterday was another closer to 20%. So it's been solid the last few days. We've been very happy about that. And this will happen practically every time there's a depeg with one of those three assets. So it sucks for some people, but for OUSD holders, it's fantastic. So that's all I wanted to add.
I appreciate that context there, and interesting dichotomy with holders kind of fingers crossing for a depeg here, but that's very interesting. Cool. Well, thanks for stopping by and adding a little bit more context. Kind of moving on to proposal updates. You may have seen Jason, and feel free to speak up. Jason had posted that the like-kind assets KIP will likely be moving to vote, or has moved to vote, and really a lot of this. This has been on the forum for 2-3 months at this point, and this is going to be a really, really, at least in my opinion, valuable tool to allow us to react to market forces in a much more nimble way. So what this KIP really does is, instead of requiring every Treasury action to go through governance, it looks at the nature of certain actions and assesses for how reversible the transaction is and how much impact it could have. So what you'll see in those is that the actions proposed to not have to go through general governance and allow us to have discretion to a small team are the ones where it's like swapping stablecoins, so very low impact and very highly reversible. But in situations where there could be a potential depeg, it could allow us to easily have swapped right into USDT as the safe haven asset in this case, or whatever the situation. Maybe it's the opposite. Maybe USDT is looking like it's going to depeg and we would need to get out into something else. So really happy that we can have this go to vote. I really encourage you guys to go read it. Hopefully you support it, but if you don't, feel free to let me know if you have any questions or concerns at this point. But again, this will be a really nice tool to allow us just to really react to market forces, much more quickly. And then the other one that I just want to give an update on was I made some changes to the lab budget request. Again, just because of the major backlog we had, as well as the nomination of and onboarding of the new SOFON. It's been a little bit slower from getting our lab budget request hopefully approved. So at this point, I basically just added the quarterly request for Q2 as well. And so I encourage everybody to kind of check that out. I don't think that there's anything overly material about those changes outside of just incremental of dollars because of extra time and more activity in that quarter. So go check that out as well if you're interested in that. And I know Jason, any other updates or context you want to provide from a governance perspective?
No, I think that's it. We're really trying to get through the most urgent ones first. So these are obviously the ones we need to get through. So there's this one, the budget KIP, and the extension of leadership, and hopefully we'll be getting those to a vote soon, and then we can really start tackling the backlog. And the discretionary swapping of like-kind assets is live, and it'll be live for voting until Friday at 2 p.m.
Awesome. Appreciate that, sir.
Matt, I just want to quickly speak up in support of the budget KIP. Just because obviously we're nearing the end of Q1 here. I think it's important for costs to be able to be covered. For folks that want to look through it and compare it to previous budgets, I think that Matt and the rest of the kind of the directors, really tried to do as much as we could to spend as little as possible. We cut a lot from the budget. We know that in these times it's good to be kind of fiscally conservative here. And so for us, what you're going to see in there is stuff to kind of keep us moving and keep our contractors on and keep our services up. So I would just say that I support it and that it's important for us to kind of get moving on that.
Yeah, appreciate that, sir. Anybody else have any comments about any proposals that are on the forum, or any ones I've kind of just given a more specific update about? Great. Well, again, I know I kind of talked about this at the top and kind of referenced it, but we are going to kind of get into the Silicon Valley Bank collapse a little bit more and just kind of at a high level. One thing I just want to say, and I know 50 is going to kind of take the lead on this section, is that you'll see, I think, maybe we're a little bit biased because we're operating in the space, but you're going to see a lot of FUD just around how crypto may have contributed to some of these bank collapses. From my perspective, this is, maybe there's a very small portion of that may be true, at least with Silvergate, but with these other two banks, they're very, very nuanced. They're very different. And I would say it's very much comes down to the risk management of these banks, as well as just overall market forces that really contributed the vast majority of what caused all this. So do you want to take it away from here?
Yeah, sure thing. So just to start piggybacking off what you've said there, it's a neat story to kind of just blame everything on crypto. It's a very useful scapegoat, as it were. But the actual what actually went on with Silicon Valley Bank is it's more nuanced and also more boring. So just to go through it at a high level. In the period of 0% interest rates, a ton of capital, I think about $89 billion worth of capital, flowed in from companies to Silicon Valley Bank. Now, the way that banks operate, the way that banks actually generate profit, is they take customer deposits and they deploy that into kind of yield-generating strategies of a very kind of safe and regulated kind. Those being Treasury-backed mortgage-backed securities, T-bills, basically kind of government-backed securities. Now, what happened so these banks had all this capital and they had to deploy it in a period of 0% interest rates. Now, interest rates happen to be inversely proportional to the price of these securities. So when interest rates were zero, they were really expensive to buy. So Silicon Valley Bank had to buy these securities to keep the business alive, basically. And they also had to buy longer dated securities because the interest rates were super low. There was no other way that they could kind of feasibly remain profitable. So then what you had after that is in the years, in the meantime, let's say, the Fed has obviously kind of hiked interest rates very aggressively. Again, going back to the kind of inverse relationship between the two, that means that the price of these securities that Silicon Valley Bank now holds it's just been slashed. They've got massive kind of unrealized losses, which on paper isn't necessarily the worst thing in the world. Banks tend to operate with large amounts of unrealized losses at different points in time. That's kind of normal operating procedure. But what happened is that a kind of an inflow of withdrawal requests started to come into Silicon Valley Bank. Now, what they had to do was first they had to sell their kind of available for sale assets at a massive loss. So I think they clocked in around like a 1.8 billion realized loss with those first round of asset sales. And then this kind of triggered what you would call a bank run. That's the buzzword, which essentially just means a cascade of withdrawal requests. So in order to have to meet this, these withdrawal requests, they've had to sell more of these assets at a loss. And this is just this compounding spiral where the main risk is that the main fear rather is that they don't have enough they don't have enough liquidity available to cover all the withdrawal requests. So yeah, it's not necessarily kind of related to crypto it's tangentially related to crypto, but that's not the direct reason. This is more just a case of kind of macroeconomic policy at the Fed level. Does anybody have any questions on that? I know that's quite a lot of information.
I'm going to overload you guys a little bit more with a couple of things to fill in some gaps. But yeah, if anybody has any questions, feel free to ask any now.
Yeah, so thank you. That was a great summary. And I was just wondering something that doesn't get discussed a lot in conversations about this is the fact that they had to go to market to plug some of the hole in their balance sheet. And that seems to have happened at the worst possible time. I think it was the day that Silvergate announced it was failing, or that there was some weird overlap there. And I was just wondering if those of you who have been studying it think this would have happened if they hadn't done that. Because if I remember correctly, they announced that they were seeking to raise equity capital on Wednesday, and on Thursday was when the run started, or maybe it was Friday. I don't know. Just curious what you guys think of that.
What's your question? Sorry. Do
you think how much of a role do you think that played? The needing to go to the market and sort of publicizing the problems with the balance sheet.
Yeah, that's a good question. So I see that more as kind of like the spark that lit all of this. Like the kind of the proverbial gasoline was kind of collecting anyway, just with the macroeconomic forces that that it just kind of. Sorry, I just completely lost my train of thought there. Let me start that again. Yes, I think that was the kind of catalyst that triggers everything off, but the groundwork for all of the problems that we're seeing now has been in effect for multiple years. This is the kind of continuation of Fed policy.
Yeah, and maybe answer your question a little more specifically. I think there's probably an argument that they were functionally insolvent, probably even the previous quarter, for at least from my understanding. And to maybe answer your question a little bit more broad, or maybe more with more nuance and detail to it. One thing to note about the equity is like that's a bank's way that they can kind of fill gaps. Their equity is essentially how they can cover like deficit and meet like liquidity in times of these situations. However, like so one thing to note is that banks and me being a CPA, like I kind of nerd out to this stuff, but banks, they have the option, I think even 50 alluded to it, but they can tag these type of investments that they have in these bonds or mortgage-backed securities or whatever the product may be that they hold. They can tag that either available for sale, which means they mark to market on a rolling basis. So every time there's a change in value, they recognize that and it actually hits their P&L. If it's held to maturity, they've basically made a commitment that they will not, and sell these assets or swap them or whatever it may be, and they don't need to recognize those impairments if there is like a change in value. So that only hits the unrealized gain or loss, right? So when you think about it from an accounting perspective, if your P&L starts going down because you start actually having to recognize all of these unrealized losses that were previously not showing up there, then your equity actually starts taking a hit where you need to start kind of raising some cash and taking away from equity just to kind of cover those gaps. And so by the time they tried to do that, I think it was effectively too late. And also, like, one thing to know is, like, I don't think a lot of people had confidence in raising when a lot of the executives were, giving themselves bonuses and actually cashing out. I think like maybe a week or two before or something like that. So it's part of it, but it's not the only catalyst. I would say this is probably a product of a lot of things, but one thing to know is it's definitely a product of the structure of the laws and regulations that kind of force these banks to engage in this behavior. So one thing to note is that banks have to have a certain like LCR, liquidity coverage ratio. And really what this is this looks at like the number of, I think it's called HQLA, or high quality liquid assets, that they have to cover like cash outflows. And a lot of banks, I think it's above 250 billion, they have to actually go through like these stress test procedures. I think sometime in 2018, a lot of these stress test requirements for banks of this size, because I think Silicon Valley was about 200 billion, and I think the requirement again for these stress tests is like 250 billion. So they didn't have to go through these stress tests that would have maybe identified these issues. But with regards to these high quality liquid assets, like essentially the lobbyists in DC, they lobbied hard as shit to get mortgage-backed securities, other long-duration bonds that they could be classified as HQLs. So these banks were incentivized to take more risk by going out on the farther end of the spectrum, and whether that's higher bonds or bonds that yield more because they're longer dated or whatever it may be. But that they're really there's probably an argument that they're not actually high quality, right? So that's definitely part of the issue as well. And then last thing I'll say, without getting into like just too much detail, 'cause I'm sure I'm boring everybody, is that most banks, they have like when they have like interest rate risk, like we've seen here, they typically hedge it, right, with some kind of interest rate swap. Funny enough, Silicon Valley Bank had zero hedges, which is wildly rare for a bank with that much exposure. And then the final piece I'll say is typically banks have a good composition of their deposit base between ones that have liability, so meaning ones that have over $250,000 above the FDIC limit, and then ones that are under that limit. And so they typically have a good composition that balances those two cohorts of populations. And I'm pretty sure that Silicon Valley Bank, I want to say like the number, and maybe I'm confusing with another metric, but it was like 89% unsecured deposits. So that was also a really huge contributing factor to what we saw here. I apologize for overloading everybody. Just want to give you guys more information on really what went down and what caused that. And honestly, probably more specifically, like how you can pay attention to other banks that may be into the conversation and, have a little bit of KPIs to kind of measure them against. Anybody have any questions about that? Okay, cool. Well, I guess packaging all up and how it relates to USDC, obviously, these banks that we refer to, USDC or Circle had exposure to. I believe it was about an 8% exposure to Silicon Valley Bank with regards to the actual cash. So one thing to note is when an entity like Circle puts their cash or assets with the bank, the cash is actually what's at risk here. And if it's a security like a T-bill or a Treasury bond, those are actually segregated into separate accounts. So there's a lot less risk with those. So the risk here with Circle was that they split their actual cash up with, I think, 6 different banks, one of which was Silicon Valley, and that represented about 8% of their overall cash at risk or deposits at risk. So obviously, once that news and that awareness of that happened, we saw a USDC, I guess you could say depeg down to 88 cents or whatever it was. And then, with the reassurances by both Circle and the government and FDIC, obviously that gave people a little bit more comfort to that Circle's not going to have any issues redeeming in time. So just wanted to package that up as it relates to USDC. Okay, so enough nerding out on bank collapses. I think that was everything from a recent events and news perspective. Did anybody want to talk through any of the news events, the proposals pending, or any updates that were given in this section? Easy enough. Okay, moving on to the initiative collaboration section. I guess a couple of different things that we can discuss. I don't think I set aside, specific time for one or the other. I just want to kind of see where this kind of organically flowed. I guess we have some things that we can talk about from the improved Rook token model discussion. I know we had a very deep discussion with that during our governance workshop last week. We could probably also get into a little bit more about like the stablecoin implications of everything we just talked about, and potentially, what we could, if it was approved, leverage this like-kind KIP exchange and some kind of attacks we can develop with that. And then I also know we have our weekly Treasury report, which we're always looking for additional feedback on, so that's also linked there. So maybe I'll start with the stablecoin rebalancing discussion. And again, like if nobody has any strong thoughts about this, like 50 and I, we're going to develop a plan of attack with anybody else who is interested. But does anybody have any strong thoughts about? We have a pretty nice breakdown of stablecoins, mostly with USDC and DAI, which obviously both have exposure to USDC and Circle, right? And so with banks collapsing and centralized entities kind of, being a little bit more unknown, I just wanted to open up the floor and see if anybody has any thoughts about, whether they had any preferences about how our stablecoin allocation should look instead of how it currently does. I know Peter's like, I know there's a great stablecoin that we have for you guys. Easy enough? Okay. Well, I know 50 and I are developing a stablecoin framework. We'll continue to do that. We'll also leverage that into coming up with a more robust plan. What that looks like at this point, I'm not fully sure, but it'll definitely morph as the environment does. Another thing we can get into, if anybody would like, I know it's a tailored down meeting, I guess, with regards to the headcount here. But improved Rook token model. This is essentially the VC fund that is a stakeholder in Rook that basically would like us to explore different options, whether it's a buyback or implementing a new staking program. But they would just like to have the Rook token have a little bit more utility. So I didn't know if anybody had any additional thoughts on this that they'd like to relay here.
I kind of mentioned my thoughts kind of briefly at the governance workshop, but it just to me, in my personal opinion, just seems like pump price, but I mean eloquently worded, but that does seem to be the kind of main initiative there. I'm not sure that's something that it would be worthwhile diverting team bandwidth to kind of work on in the immediate future.
Matt, I also want to add to that, one of our SOFUNs directly responded to the proposal in full opposition of it and his reasonings for it. So Pi Show wrote in opposition to the proposal, specifically. Folks can go check it out. I don't need to speak for him.
I think all great points, and just from my perspective, like I'm not opposed by any means to any buybacks as a tool, but I'm very opposed to like predictable and scheduled buyback programs where they're like again create this expectation of profit. So I personally would really want to avoid that from a buyback perspective. And with regards to staking, like I'm just really going to defer my judgment on that aspect of it to the legal team and people who are closer to like understanding the nuances of staking contracts and how that may relate or may not relate to being classified as a security. So my assumption is that staking programs are something we should avoid. But again, I would defer to Guard and other legal members on that as well.
And I would just say restaking programs, if anyone paid attention from April to June when we ran our staking program, and its impact on the number of holders, as well as what was done with those rewards. I would say that kind of speaks for itself. As in there was no impact. So.
I mean, at least from my perspective, Rook's objective is capturing order flow, right? And any action we take and any resource that is scarce that we leverage, should keep that in mind. And so if there's no way to tie, being able to capture additional order flow to whatever action, whether it's a staking program or buyback. Like that in the end, I would think it would just be a short-term, band-aid with no long-term results. So that's just my opinion.
I would agree with that.
Okay, great. Well, does anybody else have anything they'd like to say during Treasure Tuesday? Anything they would like to put on the agenda or just kind of plant the seed for future weeks? Okay, easy enough. Well, I really appreciate you guys stopping by for another Treasury Tuesday. I hope you all stay safe out there in this crazy environment. And as always, go touch some grass and appreciate your time today. Take care, everybody.
Thank you, Sam.